Hey everyone, welcome to another edition of our Smart Investing Weekly Stock Analysis. We look at popular companies that are trending in the news, might have a potential problem wrong with them, and break them down again on a fundamental opinion, a fundamental basis, because that's what it comes down to. The numbers, that's what's important to us here at Wilsey Asset Management. With that said, if this video is informative, interesting to you, be sure to hit that subscribe button below so you're informed about our future videos. Today, we're going to kind of do something a little different. We're actually going to revisit a stock that we looked at a few months ago that, well, trending again in the news and not in a positive fashion. That company's DocuSign, their ticker symbol is DOCU.
Hey, did you see the final numbers on it? I did not see the final numbers today. I saw in the morning it was down tremendously. I think it was around 70 some dollars a share. And I was looking at it saying, gosh, at one point this stock was like $315 a share. And it did fall. I forget when we did the last YouTube on it. I think it was what, 270. Like, oh, everybody's like, oh, this is a great, maybe 240. Oh, this is a great buy. Like, no, I'd be patient.
Well, I got the numbers for you on the dates and everything. So yeah, today the stock was down 20%. So the price was $75.01. You are right. The 52-week high on this company, about $315 a share. The last time we did this video was December 3rd. And the stock was down 42% that day to $135.09. So $135.09, it was down 57% from the highs. And again, people say, there's no way it goes lower, right? That's that mentality.
Yep.
But now it's fallen another about 50% from when we did the video back on December 3rd. Now, I don't want to toot our own horns here. That's not the purpose of this. The reason we're doing this is because, again, this stock, call me crazy, we'll look at the numbers, it could fall another 50%. Because what happens is as it starts to tumble and tumble and tumble, well, 50% of 50%, well, you can still have that. If you buy in at 75 and it goes down to, let's say, 37.50, that's a 50% decline. You can have those types of declines, unfortunately.
The most dangerous thing in investing is, well, I can't go any lower. And again, you make a good point that if somebody invested before, they're down 50%. Well, they think they can't lose more, but you invest into it, you could lose another 50% or 50% for a new investment. So you've really got to look at the value of what you're paying for something and not just say because a stock fell a certain amount, well, it's down 50%. So now I should buy it because it couldn't fall another 50%. Well, of course it could because you paid a different price. And I'm probably making this more complicated.
I know.
But it's just like, just because it went down 50% doesn't mean you can't lose 50%. Maybe that's a good way to say it.
Well, exactly. And I guess the better way to look at this is saying today's price of $75.01 is down 76% compared to the 52-week high of $314. But it's down close to 50% compared to the price of $135.09 on December 3rd. And again, that $135.09, that was down more than 50% from the 52-week high. So again, that 50% of 50% is now a 75% loss. It doesn't sound as bad. They're like, oh yeah, well, I'm down 75% versus 50%. It doesn't make sense to think, oh, 50 of 50. It's just the way numbers work. You got to be very cautious of that.
That's why we do all our research and we share with our viewers here what we're looking at, because the numbers are where you get the safety. And again, I'm sure we said at the time when we looked at it, it was about 240 or no, 170, I think you said.
135.
What was it?
135.
135. That we didn't say, oh, this is a great buy. I think even then the numbers still did not look good. We said, no, not a buy now. I've looked at the numbers briefly here. I won't spoil the outcome here, but I have a feeling we look at these numbers, it may not still be a buy.
Yeah, and I did want to talk a little bit about why it was down real quick here today. And it's funny, it's the same story as last quarter, as the company beat on sales, beat on earnings. But the problem was, again, the guidance. And I'm going to pull out one other thing that is very concerning with this business. The company had a 48-cent profit per share or earnings per share on an adjusted basis. But on a GAAP, generally accepted accounting principles basis, they lost 15 cents. For the full year, it was even worse. On a, let's see, a non-GAAP basis, earnings per share were $1.98. But on a GAAP basis, they lost 36 cents. What in the world is this company backing out? And I bet you there would have been inklings of this big problem had you looked at the balance sheet income statement years ago.
And Chase, another thing too is that I think like last week, somebody, and I thought DocuSign was the only one. There's now a competitor for DocuSign. I forget the name of it, but they now have competition. So it's like, yes, it's a growing business, growing market, but you're going to have one competitor, two competitors. Could that dig into their market share? And maybe DocuSign isn't ever going to be a buy. I don't know. We'll see.
Yeah. And we talked about this again in the past, but I just want to reemphasize these growth companies. The past results don't matter at all. It all comes down to the guidance going forward. And that's exactly what happened here. As looking forward, the company's now looking at revenue of 579 million to 583 million for its next quarter. Well, the street was looking for 594 million. So that's a big miss. They also said for the full year, they expect 2.47 billion in terms of sales to 2.482 billion. Well, the street was looking for 2.61 billion. That's the issue. That huge miss on guidance. They don't care that they beat on sales and earnings in the past because it's a growth company. They want to see that growth continue. And now all of a sudden having 18% growth going forward, that's not so sexy. You don't want to pay 100 times earnings or whatever they were trading at for a company that has decent growth.
And Chase reminds me of the old saying, I've been doing this since the 80s. Back in the 80s, it was like the stockbroker knows the price of everything and the value of nothing. And I think, unfortunately, a lot of investors now and traders that are new to this are doing the same thing. They know the price of the stock, they know the price of DocuSign, but don't know the true value. And again, that's what we do here at Smart Investing, is kind of show you the values and try to point you in the right directions to get, a good value that you can hold that company for hopefully 2, 3, 4, 5 years and make a decent return.
Yeah. With that said, talking about understanding the value rather than just the price, let's take a look at those numbers for DocuSign.
Sure. All right, DocuSign, their symbol is DOCU. They're in the industry of software application. That's a pretty big industry. Not much float on the stock. I'm wondering if we're going to see that increase. It's 4.7. 76% institutional ownership, so there's probably more room for them to buy more. Their last reporting period was 10/31 is what we're looking at here. The next reporting date, that's strange. Why does it say June of 2022?
It's because they reported today.
Okay.
So with the next report date's June 2nd, but the report date was today. The numbers just aren't in yet for the 12/31.
Oh, gotcha. Okay. Well, here's the problem right at the very beginning. Price earnings ratio, nothing, no earnings. So that's not a good start. Price of sales, still expensive, 7.4 versus 6.3. Look at that price of book value, 61.9 versus 5.8. And price of cash flow does look good at 30.3 compared to the industry at 38. But the PEG ratio, which is your price earnings divided by growth, tells you what you're paying for the future growth, still looking good at 1.1 versus 5.3. But I think we'll see that decline going forward, or actually increase going forward, based on the news we heard today. Now, there's no earnings at all, so you can't have any growth or positive change in the earnings. Nice growth on sales, though, 34.7% versus 21.2%, but you got to have earnings. Can't just have sales. We do see a very nice 5-year growth rate from the analysts of 45.3 versus 26.5. I believe we'll see that come down going forward. The company does not pay a dividend. Very important always, what does a balance sheet look like? Because if you're going to hold on to this company, you want a company that can weather the storm with a strong balance sheet. We see a current ratio of 1, not as good as the industry at 2.4, but I'm okay with that. Debt to equity 380 versus 100. I did not know the debt in this company was that high. I think even before when we talked about it, if the debt was that high, we probably would have bought it anyways. I'm disappointed because I was hoping to try to find something great here, but I would never buy a company with that type of debt level. We do see that the net margin a negative 5.7% versus positive 1, which means they lose 5.7 cents for every dollar they bring in. Return on equity, not good at all, a negative 46.7 versus a positive 7.2. I mean, gosh, Chase, I'm just not seeing anything great in this company at all. And again, I want to say maybe it's a great buy here, but so far I'm not seeing anything tells me that. What do you got going forward?
Yeah, so you see here again, we talked about that current price of $75.01, 52-week high $314.76. You'll notice the 52-week low was $90.90. That's because the 52-week low was achieved today. Look at that year-to-date return, down 51%. And And that 1 year return, gosh, a loss of about 65%. Looking at the market cap of this business, you can see it is about 14.8 billion. So it is still a decent sized company. But the big thing we look at here going forward is what are those estimated earnings per share? And so you go out to January 2024. Well, it's $2.38. That actually gives a target sell price here of, let's see, $39.50. So I talked again about that potential 50% loss off the current price. Call me crazy. I mean, if things don't go according to plan, maybe it does continue to hit those speed bumps along the way. And I do believe you'll see this estimate, like the estimated earnings per share growth going forward. I think this estimate is going to be revised lower after the poor news that was reported today.
Yeah, and Chase, if you kind of move to the right a little bit, just show people the forward PE, still high. Again, 31.5. I mean, the history is like 14 to 17. That's a good time to buy. This company's still way above with a forward PE of over 31. And just, it's so hard because when you see that stock drop, even myself, I got kind of excited thinking, hey, here's a company that maybe we can invest into. But you do the research, I just can't recommend it, unfortunately. I was hoping to give the viewers a buy, but not DocuSign.
And the hard thing is, this was a COVID darling. You know, a lot of people had to do e-signature stuff because you were stuck at home, you weren't doing in-person meetings. They also talked about one of the big benefits that they had was the PPP loans. Well, we're not doing PPP loans anymore. So that drove less volume. They also said a lot of companies kind of overbought in terms of how many DocuSigns they needed in, let's say, a month, or how many that they were needing for the year. I don't know exactly how DocuSign bills. I do use them for my charity. I think they're a great service and allows you to kind of easily communicate. But, you know, you may have bought 10 for the month or 100 for the month and be like, oh, I only need 50. So now they're kind of reducing what they initially needed. That's not what you want to see for a high growth stock.
And I know that we're looking at using our firm here. Other people be using it, but you just got to get to a point to where, gosh, this company's going to make money for you. And a growth company, especially if things are slowing down, if we have perhaps a slowdown in the economy, recession, this company, you're not going to have as many signings going on. So it's just, we got to have those numbers, got to have those earnings before you invest.
Absolutely. Well, I hope you guys found this video informational here again today. And just as a reminder, it is for informational purpose only and should not be used as an investment advice. If you did like the content, you found it very informative, found it very helpful, be sure to hit that subscribe button below so you're informed for our future videos. Thanks again for watching. We'll see you here again soon.